Joining us now is Brian Rehling, head of global fixed income strategy at Wells Fargo Investment Institute. Brian, it's good to talk to you. So you don't think buyers are going to come in for treasuries here?
I mean, we could see a brief relief rally, but I don't see any reason why the current trend of higher rates is ready to end. You know, until the data changes, until there's evidence that the Fed is going to have to turn to a more friendly institution to investors, I see no reason why the most recent trends can't continue.
So where do you think we're headed into 2024? When do you think the Fed changes its policy?
Yeah, I mean, it all comes down to me to obviously the economy. The consumer continues to spend. Employers continue to employ. If we see those trends change, then the Fed can once again become our friend. But absent those changes, I think the Fed's going to have more work to do into next year. Now, the market is clearly susceptible to something breaking. Something could break at any time. But predicting that break, I think is a fool's game. So again, I think in the short term, there's upside in yields. Now, for an investor, a longer-term investor, I actually think dollar cost averaging in here to long-term bonds and locking in some of these yields for the long term makes a lot of sense, because I do believe strongly that the Fed will win the war on inflation. And you're looking at locking in some really attractive real yields at current levels.
I guess, Brian, I guess what's somewhat reassuring is that you still think there's a line between inflation and economic activity and the bond market, as opposed to some who argue it's sort of been more closely tied now to external affairs, international dynamics. You wouldn't want to see something as sinister as a weak economy and continued elevated yields.
That would be worrisome. I mean, I'm a bit concerned about the fiscal situation and the dysfunction in Washington. No doubt that has an impact on investors, especially in global investors. But I still believe when something breaks, when we have that big risk-off moment in the markets, likely around some type of a recession, et cetera, that, investors are going to gravitate back to what they always have in the past, and that is those high-quality fixed income instruments. And you see the best price movement on, obviously, those long-term bonds in such a situation.
Are you beginning to wonder whether or not, there's a Barclays note that sort of hinted at this, that it would take a hard sell-off, a violent sell-off in stocks and risk assets to bring bond stabilization?
I think so. Yeah, I mean, just this kind of slow, steady sell-off. I don't think that drives the investors into those long-term fixed income, treasury securities. I think you need something to break. You need some strong indication that, the economy is really turning over. And, I think we'll get that at some point. Now, does that come, in the next month or two? Does it come early next year, or does it come after the elections next year? That's much more uncertain. And you really just have to, I think, play it in those short-term moves, as the data comes in, as, those developments unfold. Predicting the break and what breaks is, like I said, a fool's game, I think.